There's a point in every market cycle where silence becomes more dangerous than action. We are standing at that point right now in silver. While most people are distracted by noise, a small group is quietly positioning themselves for what comes next. The question is no longer whether silver will move. The real question is who will be ready when it does. Today, we break down the exact silver threshold that separates casual buyers from the top 1% of stackers. When we talk about the top 1% silver stackers, we are not talking about a label, a social media trend, or a casual investing identity. We are talking about a very specific financial behavior pattern that separates those who accumulate metal with conviction from those who merely experiment with it. The first key point that must be understood is that the top 1% is not defined by income, nor by background, nor even by the total wealth a person starts with. It is defined by consistency, discipline, and the ability to recognize silver not as a trade, but as a long-term positioning asset in a changing monetary system. Most people enter the silver market through emotion. They hear a price prediction, they see a spike in interest, or they feel fear about inflation, and they make a purchase decision based on urgency rather than structure. That behavior alone immediately places them outside the top 1%. The top 1% do not enter because of hype, they enter because of understanding. They recognize that silver has always been a monetary metal, not just a commodity, and that its role in the global financial system is deeply underappreciated in modern markets dominated by paper assets. To understand what separates this elite group, we need to break down the psychology of accumulation. The average participant buys silver when they feel safe, when disposable income is available, or when headlines validate their fear. The top 1% stackers operate differently. They buy on schedule, not sentiment. They accumulate during boredom, not excitement. They continue even when price action discourages participation because their focus is not on short-term valuation, but on long-term positioning against systemic risk. This is where the concept of an exact silver amount becomes important, but not in the simplistic sense people often assume. There is no universal magical number that instantly elevates someone into the top 1%. Instead, there is a behavioral threshold that, once crossed, changes the way a person interacts with the entire financial system. For some, that threshold might be 100 ounces. For others, it may be 500, 1,000, or more. But the number itself is secondary. What matters is that the accumulation becomes intentional, structured, and resistant to emotional disruption. The top 1% stackers understand that silver is not just about wealth preservation, it is about wealth insulation. They view each ounce not as a speculative unit, but as a stored claim on energy, labor, and industrial necessity. This mindset transforms the act of stacking from a hobby into a strategic allocation of capital. When a person reaches this level of thinking, their behavior becomes predictable in the best possible way. They do not abandon their plan during volatility. They do not chase unrelated assets when narratives shift. They remain anchored to the thesis that physical silver is undervalued relative to its historical monetary role and its industrial demand profile. Another defining characteristic of this group is the rejection of leverage-based thinking. The broader market often approaches wealth creation through amplification, credit, derivatives, margin, and complex instruments. The top 1% silver stackers move in the opposite direction. They reduce counterparty exposure. They remove dependency on promises and instead prioritize possession. This is a critical distinction because it fundamentally changes risk exposure. While others are exposed to institutional failure, liquidity crisis, or policy shifts, the stacker is insulated through physical ownership. At the core of this approach is a recognition of supply constraints. Silver is not just limited in terms of mine production, it is also heavily consumed in industrial applications where recovery rates are low. This creates a structural imbalance that most retail investors fail to appreciate. The top 1% stackers study this imbalance deeply. They understand that when demand shifts even slightly upward, the price response can be disproportionate due to the tightness of available supply in deliverable form. This understanding reinforces their commitment to accumulation even when price appears stagnant. What truly defines the top 1% threshold, however, is not just quantity but resilience. Many people can accumulate during favorable conditions. Very few can continue during discouraging conditions. When silver moves sideways for long periods, interest fades, social attention shifts, and doubt increases. This is where most participants exit quietly. The top 1% do not exit. They recognize stagnation as a phase within a larger cycle, not a signal to disengage. Their conviction is built on macro awareness, not short-term chart interpretation. There is also an important psychological transformation that occurs as one moves closer to this elite group. Initially, silver is seen as an investment, then it becomes a hedge. Eventually, for the top stackers, it becomes a form of financial independence architecture. This shift is subtle but powerful. It changes the emotional weight of each purchase. Instead of asking, "Is this the right time?" the question becomes, "Does this move me closer to my allocation target?" That change alone separates reactive participants from strategic accumulators. The concept of exact amount must also be viewed through the lens of percentage allocation rather than absolute number. The top 1% stackers often think in terms of how much of their net worth is preserved in physical silver relative to paper assets. This allocation mindset is far more important than raw quantity. A person with moderate income but consistent allocation discipline can easily outperform a high-income individual who lacks structure. This is because consistency compounds positioning advantage over time. Another overlooked aspect is the patience required to reach this level. Silver stacking at the top tier is not a short campaign. It is a multi-year or even multi-decade positioning strategy. The top 1% understand that timing the perfect entry is less important than maintaining continuous exposure. They do not attempt to predict exact bottoms or tops. Instead, they average into positions across cycles, ensuring that they are never absent from the market when structural repricing occurs. It is also important to understand that this group operates with a different perception of value. While the broader market often evaluates silver in fiat terms, the top 1% evaluate it in terms of purchasing power retention. They are less concerned with daily price fluctuations and more concerned with long-term degradation of currency value. This shift in reference frame allows them to remain emotionally stable during volatility, which is essential for sustained accumulation. The transition into the top 1% is not marked by a single purchase or milestone event. It is marked by a gradual shift in identity. The individual stops seeing themselves as someone reacting to markets and starts seeing themselves as someone building a position within a long-term monetary realignment. At this stage, external opinions lose influence. Market noise becomes background static. Decisions become internalized and systematic. When we break down the exact silver amount concept properly, it becomes clear that the real threshold is not numerical but structural. It is the point at which silver becomes a deliberate pillar in a person's financial architecture rather than an optional asset. It is the point where selling becomes emotionally and strategically difficult because the metal is no longer viewed as disposable, but as essential. The top 1% stackers also recognize that scarcity perception often lags behind actual scarcity conditions. By the time mainstream awareness catches up, pricing mechanisms have already adjusted. This is why early and consistent accumulation matters more than reactive buying. They position themselves ahead of narrative shifts, not within them. At this level, even small incremental additions matter. Each ounce contributes to a long-term structural position that is designed to withstand monetary uncertainty. There is no rush, but there is also no pause. The behavior is steady, almost mechanical, but driven by deep conviction about the underlying thesis of silver's role in the global system, and within that framework, the idea of joining the top 1% becomes less about crossing a line and more about continuously operating within a mindset where accumulation is aligned with long-term monetary understanding, where each decision is detached from emotional market response, and where the focus remains on building a position that reflects awareness of supply constraints, historical precedent, and evolving industrial demand dynamics. Most investors underestimate physical silver accumulation because they approach it with the same mindset they use for stocks, crypto, or short-term trades. They assume that value is created through price movement, not through possession. This single misunderstanding is the root cause of why the majority never build meaningful positions in physical silver, even if they talk about it, even if they occasionally buy it, and even if they follow the market closely. The reality is that silver accumulation is not a market participation strategy in the traditional sense. It is a structural wealth positioning process that behaves very differently from speculative assets. The first layer of underestimation comes from perception. Most people see silver as cheap gold or as a secondary precious metal with limited importance. This framing immediately reduces its psychological weight in the mind of the investor. When something is perceived as less important, it naturally receives less attention, less capital allocation, and less commitment. Yet historically, silver has functioned as both money and industrial necessity, which places it in a dual role category that most assets never achieve. That duality alone should elevate its importance, but instead it is often mentally downgraded due to its lower price per ounce compared to gold. Another critical misunderstanding lies in how accumulation is defined. The average investor believes accumulation means buying when prices are low and stopping when prices are high. This sounds logical in theory, but in practice it leads to inconsistent behavior. It turns accumulation into a timing exercise rather than a continuous process. The top 1% stackers, however, do not treat accumulation as an event-based activity. They treat it as a structured habit that continues regardless of price fluctuations. Because of this, they gradually build positions over time, while the average investor remains stuck waiting for ideal conditions that rarely align with emotional readiness. There is also a deep psychological bias at play known as nominal thinking. People tend to anchor value to absolute numbers rather than relative purchasing power. For example, they might think silver is only worth a certain dollar amount per ounce without considering how that dollar itself is losing value over time. This creates an illusion that silver is stagnant or unimportant, when in reality the reference unit is the one changing. The top 1% stackers understand that the real measurement is not the price of silver, but the declining purchasing power of fiat currency. This shift in reference frame completely changes how accumulation is perceived. A major reason physical silver accumulation is underestimated is because it lacks immediate gratification. Unlike stocks that can show daily portfolio updates or crypto assets that can double overnight, physical silver is slow, quiet, and unexciting in the short term. It does not produce dopamine-driven feedback loops that many modern investors have become accustomed to. As a result, people lose interest quickly. They assume that if something is not rapidly appreciating, it is not valuable. The top 1% stackers reject this mindset entirely. They understand that the most important assets in a portfolio are often the least exciting in the short run, but the most powerful in the long run. Another factor is liquidity misunderstanding. Many investors assume that because silver is not as liquid as stocks or digital assets, it is therefore less efficient as an investment. However, liquidity is only one dimension of value. Physical silver's purpose is not high-frequency trading or rapid conversion. It is long-term preservation and optionality. The inability to instantly trade it is not a weakness in the stacking context. It is a feature that enforces discipline and reduces impulsive decisions. Those who underestimate this aspect often fail to build meaningful holdings because they prioritize flexibility over structure. The narrative environment also plays a major role in underestimation. Financial media rarely focuses on physical accumulation strategies. Instead, it highlights price predictions, market sentiment, and institutional flows. This creates a distorted perception where silver is seen primarily as a trading instrument rather than a monetary asset being steadily accumulated by disciplined participants. Without exposure to the accumulation mindset, most investors never develop the patience required to build a position that actually matters in a macro sense. There is also a structural misunderstanding about supply. Most people assume that because silver is still available for purchase, there is no urgency in accumulation. They equate availability with abundance. The top 1% stackers, however, differentiate between above-ground liquidity and long-term supply dynamics. They understand that a significant portion of silver is consumed in industrial processes where recovery is partial or delayed, meaning that theoretical availability does not always translate into actual deliverable supply. This distinction is critical but often ignored by casual participants. Behavioral inconsistency further deepens the problem. Many investors start stacking silver with enthusiasm, especially during periods of economic uncertainty or inflation fears. However, as conditions stabilize or attention shifts to other markets, their accumulation slows or stops entirely. This creates fragmented positioning, which never reaches critical mass. The top 1% do not behave this way. They maintain accumulation regardless of external narrative cycles, which is why their positions grow large enough to matter during macro shifts. Another subtle but powerful factor is social validation bias. People often seek confirmation from peers or online communities before committing to long-term accumulation strategies. If silver is not being actively discussed or hyped, interest declines. This dependence on external validation prevents independent conviction from forming. The top 1% stackers do not rely on social validation. Their accumulation is internally driven, based on macro understanding rather than crowd participation. The misunderstanding also extends to time horizon. Most investors operate within short to medium-term expectations, even when they claim to be long-term focused. In reality, their behavior is still influenced by quarterly thinking. If an asset does not show progress within a relatively short time frame, they lose conviction. Physical silver accumulation requires a fundamentally different time horizon, often spanning multiple economic cycles. Without adopting this longer perspective, investors repeatedly reset their accumulation journey, never reaching meaningful scale. There is also a misunderstanding about effort versus reward. Many assume that because silver is simple to understand, it must also be limited in potential return. This is a flawed assumption that confuses complexity with value. The top 1% stackers recognize that simplicity is actually an advantage. The fewer moving parts an asset has, the more stable its long-term thesis becomes. Silver does not require complex analysis to understand its core value proposition. It is scarce, industrially necessary, and historically monetary. Emotional interference is another major barrier. Investors often tie their emotional state to short-term price movements. When silver declines, they feel discouraged. When it rises, they feel euphoric. This emotional volatility disrupts consistent accumulation behavior. The top 1% remove emotion from the process as much as possible. They treat silver accumulation like infrastructure building, not entertainment or speculation. Inflation misunderstanding also plays a role. Many people think of inflation as a temporary economic condition rather than a long-term structural trend in fiat systems. Because of this, they underestimate the importance of holding assets that preserve purchasing power over extended periods. Silver is often included in this category, but its importance is diluted when inflation is seen as cyclical rather than systemic. The top 1% understand that long-term currency debasement is not an anomaly but a recurring feature of modern financial systems. Another overlooked factor is opportunity cost bias. Investors often believe that money allocated to silver is money that could have been used elsewhere for faster gains. This leads to hesitation in building substantial positions. However, this thinking ignores the role of insurance like assets in a portfolio. The top 1% stackers view silver not as a competing investment but as a foundational layer that supports overall financial resilience. Ultimately, the underestimation of physical silver accumulation comes from a combination of psychological bias, narrative distortion, short-term thinking, and misunderstanding of monetary systems. Each of these factors independently reduces participation, but together they create a powerful barrier that keeps the majority from ever reaching meaningful accumulation levels. The top 1% overcome these barriers not through complexity, but through consistency, clarity of purpose, and detachment from short-term noise.